All right, everybody, and welcome back to the main stage where we are going to talk about venture capital and DeFi. My name is Edward Fricker. I am an attorney representing privacy activists, crypto technologists, and often crypto investors as well. I'll let this illustrious panel introduce themselves one by one if you want to start.
Hey everyone, I'm Guy Wuollet. I'm a partner at A16Z Crypto. I invest primarily in decentralized infrastructure.
Hey guys, I'm Felix Hartmann, the founder and managing partner of Hartmann Capital. We run both a liquid crypto hedge fund and a Metaverse venture fund.
Hi everyone, I'm Alex Elkrief. I lead DeFi for LedgerPrime. We're a quant firm that does both liquid and illiquid market making in DeFi.
All right, let's jump straight into it, all right? DeFi protocols, some of them have done extremely well over the last couple of years, and some of them have been famous for their failures. So what would attract you to a system, a DeFi system, that you would want to invest in? And you guys can all chip in and ask each other about this kind of thing. You know, what do you want to see in a DeFi project for you to think, all right, time to invest?
I think one of the things that has really driven a lot of what has worked in crypto has been composability. And so the opportunity for multiple building blocks to come together to create something that's greater than the individual piece is something that is particularly exciting to me, but curious to hear what everyone else has to think as well.
Yeah, I'll resound composability, but beyond that, I'll also say ideally blue ocean. I think we don't need any more DEXs. We probably have a couple hundred of them already. And so on one hand, blue ocean, but also actual product market fit. I've seen more and more protocols pop up that really, they're kind of like they're building a product, but they don't have a user. So for example, we saw it a little bit in these fixed rate interest protocols, and we backed some of them, but like ultimately the people looking for fixed rate, they're not in DeFi. DeFi is degenerates, and degenerates don't need fixed income.
Yeah, I was going to say the same thing. I don't know, I can't tell you exactly what to do, but I can tell you what not to do. And thinking about the actual use, I mean, financial engineering is very interesting. And as I did financial engineering at school, it's very interesting. But there are some products that we see and that are so complicated that I really wonder who the user is. They're very elegant mathematically, but then it needs to serve a purpose. So like, I think beyond crypto, like when you start a startup in Web 2 or any other business, who's the user, who's the customer, what problem are you solving before you go into fancy equations?
All right, well then, next up, what makes a venture capitalist, I guess, someone who's a financial professional working in the venture capital space, good at their job? If you're going to pick a partner or even hire an associate, what personality traits, what skills, what kind of person you think would succeed, either as someone working for you or a partner of yours?
I think to Alex's point, a lot of these things are still fairly complicated. And so, I mean, I would personally identify more as sort of a technologist than I would an investor. And I personally try to understand quite deeply the things in which I think are interesting. And so I would bias more towards people who are really excited about crypto and the potential future and who have spent the time and effort to try and understand it as deeply as they can.
I think a really important trait is being inquisitive, and being a great listener where they can talk to a team. They always try to think the next step. So like if that happens, what happened then, and so forth. And also just dig really deep into the teams, because like there's so much that goes into VC, whether that's understanding the product, really deeply understanding the team, and then also where would it fit in the ecosystem.
Yeah, there are a lot of VCs that have cropped up everywhere, and I think it's really important to know what type of investor you are, even within the VC space. So like, we're LedgerPrime, don't come to us for brand advice or for like high-level strategic advice. We're quantitative and like we'll pick holes at your product or at your protocol, and we're actually be very active users of your protocol, but that's our niche, and for now that's all. And so being very specific about how you invest and what you invest for.
All right, so let's go into, for example, LedgerPrime, Hartmann Capital, A16Z Crypto. What makes your firm different from the others? And or you can even go into what makes a crypto VC firm different from other VC firms. But yeah, talk a little bit about what you feel is the particular strengths or the differentiating factors of the venture capital firm that you're with.
Sure. Yeah, so we're technical investors, so usually we'll be active users of your product. In general, that means, so we're quoting options for every decentralized option vault, from Ribbon to Siga to Friction and all those guys. Or, providing liquidity on Mango markets or perpetual exchanges, etc. Or building liquidator infrastructure for borderland protocol. So in general, we've had success in projects coming to us because we actually built stuff.
I would say for VC to be great is mostly about them knowing their own strengths. And so, for example, there's huge firms with massive staff, there's small shops with a few people, but everybody can have their own strengths. So for us, for example, we have a pure Metaverse fund. My analysts, they're like hardcore gamers, they're long-term crypto, they know token models, so like that's their strength, where I know we can help a lot. And also, we're a smaller team than, let's say, for example, in ASICS and Z, hence we only do, let's say, 20 to 30 portfolio companies where we can actually have a close connection, close relationship, versus there's a lot of smaller shops that try to, let's say, copy what ASICS and Z does, and they have 100 protocols. There's no chance a small shop can do that, right? So I think it's like finding your strength, and as a company, if you're going to work with a venture fund, like try to understand, do they have a value that they can bring with the current setup?
Yeah, I would say I personally make a real effort to try and understand things from first principles and to empathize with the people who are dedicating their lives, in many cases, to trying to bring something into the world. And I think that's really valuable and worth admiring. And then to Felix's point, I think we often make a significant effort to support visionary technical founders along a bunch of different dimensions where they might not have a background or as much experience. And this is the reason we have a larger team to help support the companies we work with.
All right, so if you had to ask your fellow panelists questions, like if you're curious about how other venture capitalists see it, what would you ask the other panelists?
I can start with one. So in 2020, 2021, VCs loved Flywheels, right? And so Flywheels is what helped like a lot of tokens succeed in big ways in 2021. That could be Olympus, Luna, Axie, you name it. Yet at the same time, it's those same Flywheels that tore down a lot of these projects. And whether it's for the retail that gets screwed or even the VC that's still locked up that doesn't benefit. So at the end of the day, nobody benefits from it. It looks great on paper for a second. What do you value now? How much flywheel, no flywheel? Yeah.
I think, so it's very iterative, right? Like this technology, these models are 2 or 3 years old. And so I want to believe.
So what's a flywheel?
So a flywheel is the idea that you are launching a token to incentivize, part of the utility of your token is to incentivize usage, to bootstrap the utility of your product. So in Web 2, what you do is, in general, you raise money from VCs, then you go to Google, you spend a bunch of money on ads, and you hope that users come and they stay. In crypto, we have the benefit of having tokens that we can airdrop or reward people with the hope that at some point the product starts running on its own and has legs, right? The problem is that the excesses of the past cycle have been that people are more focused on the flywheel itself than the legs of the product. And so it's reflexive on the way up, and then it's reflexive on the way down, right? Like, people get excited, the token is worth more, so the rewards are worth more, so people make a lot of money, and reflexive. And then at some point, the music stops, and it's reflexive on the way down. Lower yields, lower token value, less excitement, blah, blah, blah.
Yeah, I would personally focus on fundamentals and see, like, are people using this in a tangible way? Are they building businesses themselves or other protocols on top of it that compose with it? We had published a State of Crypto report that I think focuses on a lot of the different metrics as are applied to the different spaces within crypto more broadly. And I think that is sort of the lens through which we look at some of these things, as opposed to more of the approach that you're describing.
What is the hardest thing about being a venture capitalist in crypto? What are some things that can aggravate you and surprise you about this particular role in the industry?
I'll chime in here. So I would say I'm very like product focused and very technology focused. And something we've been really trying to like grab a grasp on is that I think in crypto a lot of times projects with no product but great marketing, big community get funded. And a lot of really great products, they might even struggle, and then they say, oh, because you don't have a huge Discord server yet. And then I'm like, well, we've got a lot of huge Discord servers that do absolutely nothing. And so I think the values of the crypto space is what I think is the hardest sometimes, where you want to play long-term games, but at the same time you need to find a way that even if you play long-term games, you stay in business long enough. When I say you, I mean the projects. Right? And so balance of the two. Because otherwise there's also a certain level of fake it till you make it in crypto, where there's a lot of projects, again, that don't do anything, but they were able to fake their way into like $1 billion market cap, and then they've got a massive treasury, and well, now they can build all the tech they want. So it's like balancing that act.
Well, we've seen a lot of change in venture capital just with the advent of tokenization of projects. So, what is different with being a crypto VC when you can tokenize things to being an investor in equity in startups?
Well, the cycle is pretty different, but I think that might have been just an excess of the past cycle. Very short vesting schedules, which mean that you have investors that are not aligned with the projects, or even the vesting applies both to the founders and to the investors, but very short incentive cycles, so people dump and disappear. I think also being super clear of where the value is going to accrue, and there's a lot of regulatory uncertainty around that, so I don't have the answers, but you see some projects that start with a token round, and then they do an equity round, and then they do another token round, and it's unclear where the monetization, where does the revenue actually accrue, and also while staying away from the regulatory risks that would come with direct value accrual to a token. So there's a lot of uncertainty there that investors have to grapple with.
Yeah, I would just say be intentional. Like, these things are probably very specific to the individual opportunity, and to evaluate each of them on their own merits and their own basis, and not to try and apply too much of one model to another where it might not map nicely.
All right, so when you're investing, let's say in a round or a seed for a project, what kind of, so often you see there's like a cap table, right? So if one of you wants to explain what a cap table is and who you want to see on the cap table.
I mean, the cap table is pretty much just the list of owners, or like the list of VCs and so forth, angels that are involved in a round. I don't think there's a one-size-fits-all. I think new teams, of course they want to shoot for the biggest names in the industry just for recognizability. Plus, it makes future raising easy. But I think we all build our own mental model, so to say, of how valuable different VCs are based on prior experience of working with them. So I've had really good experiences with even some angels and some like smaller funds. There's some amazing bigger funds. I think the most important thing is that the size of the check is meaningful enough to that institution. So, for example, I think party rounds usually are pretty wasteful, because party rounds means that people write these really tiny checks and then they don't care enough to lift a finger. You want that the size of the check is big enough where they actually will, like kind of roll up their sleeves and put in some elbow grease to help those teams.
So you call that value add investing?
Yes, everybody likes to call themselves that.
Okay, yeah. Is that so? Do you have an opinion on what value add is for a VC investing?
I'm going to repeat myself, but just being clear about what the firm is about, and also for smaller firms. A16Z has a lot more resources to support in a lot of different areas. We're a smaller firm, and so we have to be very specific about what we bring to the table and how it can be helpful.
And if I can add one more thing, I think different funds have different specialties. There's some funds that are killing it in marketing. There's some funds that are really good, like at the institutional structuring, like for example, having an acquisition, launching a token, IPOs, and so forth. Others might be more technical, where they can actually help you with audits and so forth. So figure out what their strength is, and then kind of like build a roster based on that.
Yeah, I think we would aspire to be a good partner to the projects with which we work along a number of dimensions. But to your original question, I mean, when I have the opportunity to talk with someone who's a founder or an entrepreneur, I would focus much more on what they're building and their vision for the future than their prior fundraising history.
That's a great segue to the next question. Vision for the future. We've seen a lot of trends in investing and boats that people are hopping on as the next great thing in DeFi, the next great thing in crypto. What are some trends that you see emerging in investment now? And what are some future trends that you think people would be investing in if they knew a little bit more about the way things are going?
We could write a thesis about that question, right? But
that's what we're here. We're here for the alpha.
Well, I think at least for crypto, I would ask myself I try to ask myself the question when I look at opportunities of what can crypto enable that you can't do in Web 2? Because crypto is more inefficient in a lot of ways. So what is the 10x better factor? Maybe it's network effects. Maybe it's 24/7 access. Maybe it's lower fees. But there needs to be something that can't be replicated. I'll stop there. Otherwise, we can
sure.
go.
So people want to know what's hot and what's going to be hot, right?
I personally focus on, I think, 3 main areas. The first being scalability, the second being interoperability, and the third being privacy. I think scalability is maybe fairly self-evident. Interoperability, the idea that there's a rich design space for different blockchains, and in the future, developers might choose to pick certain aspects of their application and to build on top of the infrastructure that makes the most sense. And it has historically been somewhat of a challenge to tie together different chains and to build an app that has logic on multiple at once. And so I think there's a strong potential future there, although it's still early. And then thirdly, being privacy, having entirely transparent blockchains is, in my opinion, not the way things will move forward. And that's an effort that I'm personally excited about.
Yeah, I mean, ideologically, I think, especially with what's happening right now, I'm definitely with you on the privacy side. We just had the events with Tornado Cash. I think it's super, super important. Of course, also big fans of Railgun. Personally, we invest a lot in Metaverse right now. I know Metaverse was kind of like a hype in 2021, and to me, I think the Metaverse looks a lot different than what most people think. It's not necessarily, the really early stage Gen 1 things that we saw last year. But, I would say not betting on the Metaverse for the next 5 to 10 years is a mistake because, we already live in a digital world, and it's just like the next iteration of it that becomes more and more immersive and ownership-based.
All right, so now a lot of people who are founding projects, they might be young, they might be relatively inexperienced in the financial world, but extremely talented with a great vision. How does someone like that get in touch and looked at by people like you?
We're actually very open to being reached out to, both on Twitter or at those conferences or on Discord or anywhere. So any one of the above or on our website, really.
So for example, a founder would create a Twitter account and send you a DM or something like that?
Yeah, absolutely.
Good.
I would absolutely echo that. Please send me cold DMs on Twitter. I love that.
Yeah, and same with us. Ideally, we even email. You can send us your deck and info. Now, what I will say is make that contact when you think you're ready. Because we always take a first look, meaning every single project comes in the door, we'll take a look at. Will we take a second, a third, and fourth look? That gets trickier. So make sure you have a clean deck. You know what you're doing. You know what you're building. Especially applies to you when you pre-seed. Of course, if you already passed pre-seed, you probably have some kind of product already.
Okay, so you're saying send a Twitter DM, but need a deck already, right? So explain what a deck is for people who have never used a slide projector.
Yeah, I mean, a deck is pretty much, let's say, a 15-slide presentation, that covers everything from what is the product you're looking to build, maybe what problem does it solve, what's the market for that, who are you, what's the team looking like, and how much money you're raising, and maybe why are you raising that money, what do you need it for? And if you've already had some kind of traction success, whether that's sales or partnerships, put that in there as well, right? I mean, and the real goal nobody's going to invest based on the deck. The goal is to get on a call, right? So we'll flip through that deck in, let's say, 10 minutes and be like, hey, this is interesting. Let's explore more, right? And then we get on a call. And then, this process can last a month. It can last 2 months. It's just get enough that we're interested in taking a further look.
For some of the projects that are more technically inclined, I personally find it very helpful to have something like a spec or a white paper that details how some things work, and you know, that is the sort of thing that I prefer to dig into much more deeply, although certainly having some of that higher level context from a deck can be very helpful as well.
I mean, favorite was if you have a demo, you know, then it's not just about like, this is what I want to do, but like, hey, we already built something like it. Let me show you.
All right, so what we're going to do now is open up to the audience for questions. We'll have 20 minutes from the audience, so a lot of time to get some great questions and a lot of discussion based on what the DeFiCon attendees are interested in.
Hi. So there's a lot of discussion if investment DAO will disrupt crypto venture capital or not. So the personal thinking is I think I'm almost also BC, and then I think personally they're coexisting in the future. What I want to know about panel's thoughts on that.
All right, so I guess the question you could say, how would investment DAOs be disrupting the venture capital industry, right?
I think investment DAOs come in pretty nicely for, let's say, like pre-seed investing, almost like a collective of angels, because it's people from the community that know the space well, they can make introductions. Maybe they themselves don't have enough money to fund those, but as a unit, they can. Now, what I have seen, you know, I think investment DAOs sound better in theory than in practice. In practice, they can be pretty messy, where it's, you know, 50 cooks in the kitchen, and sometimes the decision process literally like thumbs up emojis, and if there's enough thumbs up emojis, somebody hits the trigger. And furthermore, if there's a VC in there that says, hey, I like for example, there's some DAOs for like deciding to purchase NFTs. If I'm in the DAO, I can be like, they want to buy this NFT, all right, I'm just going to buy it, right? And
what is an investment DAO?
Well, a DAO is a decentralized autonomous organization, right? So it's like a decentralized LLC pretty much. Everybody buys in. Generally, you know, maybe it's like, let's say 10 ETH to buy in, and then there's 500 people doing that, so now there's 5,000 ETH, and everybody has a little, you know, DAO membership token. And if it's done well, it's all on chain, and you guys can vote on those decisions, but a lot of times it's kind of like, you know, again, in Discord servers, maybe somebody is actually in charge of the contracts, maybe there's a multi-sig of like 5 people or so, and just by basic consensus in Discord, or maybe by snapshot, you make decisions together.
Yeah, there are two things that worry me about DAOs, and I think investment DAOs in particular. One, and this is by no means saying that it's not solvable, it's just the current state of affairs. One is really governance, and to what you were alluding to, I think if you have 500 people making investment decisions, it's probably problematic. And that's true also every other DAO for decentralized governance in general, like asking one token, one vote is probably not the most efficient way to make decisions. But then if you delegate those decisions to a smaller group of individuals, there's a lot of regulatory uncertainty around does that become an investment product, and what are the constraints around that? Syndicate DAO and others are doing a lot of work around that, and there is certainly a way to create and operate an investment vehicle in a much more efficiently and with much lower costs. But we need to solve the reg questions first, because we can't operate in the gray area forever.
Yeah, to the original question, I think one way to understand or try to understand the future is to look at the past. And there's a really interesting book called VC in American History that I think a Harvard professor, Tom Nicholson, if I recall correctly, wrote, where he goes through the history of value-add risk capital, at least in North America. And it starts with whaling in the late 1700s and sort of walks through to modern day. And I think one way you might try and understand what the future will look like is to say, what are the attributes that have persisted throughout time, and how have the changes in what we can do technically affected that, and then to try and forecast that onto the future. And that's something that I feel I have a dubious ability to do precisely.
Great, yeah, great question. Thanks so much. And yeah, let's field another one.
Hi, I'm Daniel from Pendulum, a power chain on Polkadot. I have a question for each one of you guys. When the market is in different conditions, is it affecting your strategy of investment? Do you have a different decision process when the market is in a position A or B? Is that make any changes?
Okay, so basically, when it's a bullish or when it's bearish, do you change your thesis in investing? Yeah.
Exactly,
Okay,
yeah.
So I mean, as a hedge fund, 100%. As a venture fund, honestly, no. And I think that should be the ideal answer. If your behaviors change too much based on the market, then you probably were too exuberant to begin with. You know, so like I wasn't rushing into rounds, you know, before the market crashed. Now, like there's a lot of people that do the extremes. They write one-day checks. They get pitched. They're like, here's my money. Shut up, take it, right? And then now they're like, we talked about this in the green room. We're like, we're off on vacation for the next 3 months. Talk to you then, right? And I think neither makes that much sense. I think we've been deploying every single month the last 8 months, and there's great deals now. You know, like yes, can you negotiate more? 100%, right? Know what part of the market you're in. So like now it's more of a buyer's market. So while there are some startups that were quoting pretty much triple the valuations, they're now saying we'll take 1/3 of that valuation. Great, be aware of that and negotiate like an intelligent person. But doesn't mean I'm stopping investment.
My short answer would be no. I think crypto will be very important for the future of probably the world and at least the internet. And we take a very long-term view. And so no, I don't think market fluctuations make that much of an impact.
I'll echo that as well. We don't really change our decision-making process. It's just by nature of, one, it being August and people having been burnt out for the past 2 years, and people just take longer to make decisions because there's less competition for deals, and that's just human nature. But you shouldn't change your thesis, right? Then there would be a problem. Then on the liquid side, it's a different story, and we're also a hedge fund, so you adapt to new information. But for longer-term play, absolutely not.
All right. Yeah, so I also heard that buy low, sell high is a good strategy. I don't know, not financial advice, but yeah. All right. Who's another question?
In the crypto community, there is a lot of animosity towards VCs because they have, to characterize it, they're a bunch of crypto sharks that pump and dump. What are the panel's reaction towards that animosity? And just curious to hear your guys' thoughts on that.
All right, so basically the question is, some people are antagonistic towards whales or corporate VCs, and they've got a bad reputation in the market sometimes. So how have you reacted to that kind of thing? Yep, okay, cool.
I don't think you can generalize. Yes, there are a lot of bad actors, and there are a lot of bad actors in every industry. I'm not here to badmouth people, so I won't. But there are a lot. We have seen behaviors of buying and dumping or dumping at the first opportunity, and that's been the case in previous cycles as well. But also, without longer-term patient capital, you wouldn't have been able to fund teams to develop completely novel ideas for years. So, you have to pick your investors wisely as well.
Yeah, so I mean, I sat on the other side of the table for the last 4 years, where I was a liquid hedge fund, meaning it's more like the VCs were on the other side, and I just recently, like a year ago roughly, started my own VC as a second fund, and I think it's very easy to villainize VCs when you have to realize you're the one that set the vesting schedule, right? If you don't want them to dump, then make it more linear, right? Or make it longer. But ultimately, you join a contract, right? They forewent upside, let's say, over a span of 3 years, right? And for them, it's a business too. They've got LPs. They've got people. It's not just kumbaya that we're gonna be invested together. They took a lot of risk, and also nobody bats an eye every single time a VC loses money. So I would say if you're afraid of dumping happening, so to say, then adjust the vesting schedule, right? And provide options to provide liquidity, right? Partner with market makers, right? If you hear that there's people wanting to buy OTC, maybe facilitate that. I know a lot of good teams that have done well with that. That, for example, they get approached by people wanting to buy, they connect them up with other VCs that want to get out, right? So I think it's a team effort.
I'm not sure I feel the animosity you're citing. I spend a lot of time talking with a lot of people, and I think for the most part, everyone in crypto is smart and kind and trying to build a better vision of the future. And that, maybe there are some exceptions, but that's certainly not been my experience. I think most people are great.
Great. All right. Yep.
Yeah, I want to know more about some maybe red flags you see when you're meeting projects for the first time. Things that jump out at you, that are just big, no, walk away. This is a red flag. Maybe you have a couple of stories, major ones from the past.
All right. Have you ever seen a red flag, this kind of question? Yeah, cool.
Don't talk about tokenomics before you talk about the problem you're solving and who your customer is.
For me, it's two things. I think one, like overdoing the buzzwords, like it's if you feel like you're talking, you're trying to like shill to the masses, but you're having a conversation with a VC, I'm like, I can see through all those buzzwords and they mean zero. So that's one. And the second one, when you're too hungry on day one, like a pre-seed, there was 2 pre-seed projects that like I actually liked, I want to back, but the founders were too concerned about like their payout, so to say, whether that is like absurd, you know, like pre-seed salaries. We're talking, let's say, 50K a month, to, you know, weird clause in the contract that said they get a cash pay, like 7-figure cash payout, like 1 year in or something like that. It's just like, don't shoot yourself in the foot, right? I mean, this is a long-term game. We're all playing together, right? And so if you do well, you'll make plenty of money. But if you're too concerned about the financials on like pre-seed, that's a red flag to me.
One idea that we talk about is the idea maze, basically that for any given challenge or design space, there are a lot of different possibilities. And the way I view having a conversation with a founder or an entrepreneur is walking through the idea maze with them and trying to understand how they think and what parts of the maze they have explored or potentially haven't. So I wouldn't say anything is necessarily specific there.
Great. Yep.
There was a great tweet the other day that men used to wage war, and now they launch layer ones. So curious how you think for an early stage founder, you know, having to choose to build on seemingly there's a new one every month, how they should be thinking about that, first of all, and then how you're looking at it, kind of the broader market for, is interoperability more important? Is it more important for a founder to just kind of land and expand and just keep adding chains, given that so much of it is still kind of, you know, still maturing, and, you know, I'm sure every founder wants to, you know, achieve their highest TAM. So, yeah, curious how you think about that.
So I guess you could say it's tough for a founder to know which blockchain to build on. And so as an investor, what's your advice to them? Okay.
I would say there's 3 core factors. One is where are your users, right? So like there's lots of layer 1 blockchains with, you know, maybe a couple thousand people that even have that wallet installed, right? Or even have that RPC added to their MetaMask. Well, then you're leaving users behind. So like one is where are the users. Number 2 is for that specific niche, does this chain provide extra friction, right? For example, do they need to download a whole nother you know, wallet? Do they need to do more onboarding? Or does it maybe even have some Web 2 you know, I guess features where they can just use like for Metaverse is important that they can just use password and username. And then part 3, money. Right now, there is so many layer 1s, so they're fighting for good developers. And a lot of times it doesn't have to come with exclusivity. So it might be okay if a project is just, you know, getting off the ground, right? That they say, hey, this blockchain will give us $500,000 in a grant, and we'll build on them for the first, let's say, 1 year to get off the ground, and then you can always still go multi-chain afterwards. Now the last factor, which I've mentioned, of course, is also the programming language. Now there's, you know, whether Solidity, Rust, or I forgot what's Move? Yeah, Move with Sui and Aptos, right? You don't want to rebuild your entire code base, so at least know where do you want to end up in the final stages, which in my eyes is probably always going to be Ethereum, but I'm biased there.
I guess my personal opinion would be that the infrastructure you choose to build on would depend on the sort of application you're choosing to build. And to that end, I think education is really important, and we've made, you know, a significant effort to publish a lot of blogs, a podcast, and you know, I think it's worthwhile taking the time to really understand the choices you're making from an infrastructure perspective and how those will impact your application moving forward.
All right, so let's see how we're doing for time. Yep, we can get another question. Yep.
Hi. You guys spoke about investment DAOs. I want to ask about the inverse, investing in DAOs. I've spoken to a VC who, like, when pitching our DAO, he said, well, what about your centralized company? We'd want to purchase tokens in the DAO and your centralized company. So now this new sort of paradigm has opened up where there's 2 different things to invest in. And he was sort of saying, like, this is what VCs do in crypto. I got to take his word for it. What do I know? So now I have an opportunity to ask some other VCs, what do you think about this new sort of way of investing where there's 2 different types of assets? Are you interested in one, both, or how does that work?
I think you have to be very clear about what you're building and whether the value of your company is going, or of the project you're building is going to accrue to the token or to a centralized entity. In general, the structure is that a DAO will appoint a centralized entity to develop the software and then decentralize over time, and eventually the objective is for the quote-unquote labs entity to be dissolved because the decision-making process and the operations are self-sustainable on the DAO. Now, not everything needs to be a DAO, and it's possible that you're actually building a labs or an entity that will spin up projects, and they want to have exposure to this project and the next project and the next project, and you're actually just trying out ideas. And so I think on our side we have a lot of difficulty trying to understand where that's going to happen, because everybody's figuring it out as they go, and we also end up or have ended up investing in tokens where in the end the team will decide to shut down this project, use the same entity and use the money that they raised to launch another token project, and the value really accrues to the equity of the company. So there's no simple answer, but align with what you're trying to build and make that clear to both investors and yourself.
All right, so that's it for the questions, but let's wrap it up with one final juicy tidbit. What is the best investment you've ever made? One line. What is the best investment you've ever made as yourself or your current firm? Let's just get it, just before we wrap up, from each of you. Go.
Buying ETH.
All right.
Bought Luna 20 cents, sold at 85.
What was it?
I said bought Luna 20 cents and sold at 85.
Nice.
Dollars.
I'm fortunate to have the chance to work with a lot of great people.
The real investment was the friends you made along the way. All right, guys, thanks very much.